Hello, everyone. Don Garman here from Mirador Capital Partners. Here we are. The Q3 earnings season is underway. Started this morning with JP Morgan and Goldman Sachs. And of course, we're getting our first look at the sort of messaging around how CEOs are going to be talking about Q3 and the supply chain challenges and the ongoing pandemic issues. And so that is going to be top of mind here for the next several weeks. Thought I would take just a minute and kind of catch you up on our thinking and our playbook and a little bit of sort of how we're viewing the next several months. And first, I'll go back a little bit before we go forward, which is to say that several months ago, we started talking about, sort of when kids got back into school and getting into the fall, expecting that we would be in somewhat of a reset mode and experiencing a little bit of chop. And I think that's certainly what we've been in. Certainly September was, a challenging month. And then that's persisted a little bit. A lot of circulating winds, a lot of tension underneath. Semiconductors, which are a very cyclical group, have sort of rolled over and are back to where they were really in the middle of January. And so that is giving a lot of people some concern. So I thought it'd be worthwhile to take a step back and talk about, kind of one of the enduring themes of these videos now for many years actually has been the way that we track earnings in the future and really the strength of earnings revisions, either upward or downward. And that really gives us some good, a good directional feel for kind of where the next big moves might be. So the way I'm thinking about this period, and I think our investment committee has sort of, the big themes that we're looking at are, kind of beginning of the pandemic, 20 months ago, but when we were kind of envisioning the economy being shut, and really the way they responded to it was in response to the pandemic 100 years ago when, they kind of decided to, they didn't have the same kind of tools. They let it rip. And as a result, many, many more people died, certainly as a percentage of the population. And even though we're at 700,000 deaths in the United States, the percentage of the population was much, much larger than that. And certainly we're seeing some signs that it might be abating a little bit, which is great news. But that was really the idea of the shutdowns, and stopping the spread and, kind of getting everybody sheltered in place so that we weren't all spreading it to each other in that really vicious way, which clogged up the hospitals and all the, those tense narratives that we all lived through day by day a year and a half ago. But that was the idea. And in response to that, the government, put tons of liquidity in the system, this sort of medicine. So they took the patient into a coma, and then they, strapped the iron lung on and, did all the things that you do to keep the patient alive. And then now that with the bond purchases and the QE, this is sort of medicine to resuscitate and strengthen the patient so that they can go on and live without the medicine. So the reason I bring it up in that way is the Fed just signaled today that they're starting in November, just a month away, to start to taper the bond purchases. And so why they're signaling this gradual, and they're really leaning into this gradual tapering, is because, like you might do with the medicine dose, you reduce and reduce and reduce in hopes that the body or the patient gets stronger and stronger and stronger. Because ultimately, if you're requiring the iron lung to live forever, that's not a sign of a healthy patient. So we're trying to get back to a more healthy economy where the natural forces of supply and demand and the way that our economy can work and should work to produce growth in a larger pie and hopefully a larger global pie. Those are the sort of global or larger forces that we're trying to get back to. We're not there yet. So because of the supply chain and other factors, which they have said, and we hope are temporary, inflation has really been strongest in many, many years. And as a result, those of you who are receiving Social Security payments are going to be getting your biggest raise, I think they might have said ever, which is, I think they said a 5.7 or 5.9% increase next year over your Social Security this year. Great news for you. A big increase in costs for the government after we've just spent a whole bunch of money in stimulus and other factors. So it puts in some sense, more money in the system and a little more strain on the system, which is just fine as long as the patient is getting stronger and the economy is getting back to normal, where we can absorb those additional stresses. So this is the key. The earnings in the future, the estimates for earnings in the future have stopped rising, and they're rising at a lower rate than they have in some time. So we're all kind of, simultaneously recognizing that all the costs that came out in 20, a lot of them have come back in. Airports are full again. People are, in some sense, making more money than they were in the past. And so now we're back in that any slowdown in the economy is really going to come right through to the bottom line and hurt earnings, which isn't good for the prices of companies, right? So that's kind of how the formula works. And so that's, when that peaked and rolled over is in that September period where stocks kind of started to, digest or take a pause, if you will, or pull back a little bit, which is in reality what's happened. What happens next? Well, we have to see if the forces of the body strengthening are going to outweigh the withdrawal of the medicine or the reduction of medicine, or is the patient not going to recover as we expect? And then, that's the kind of tension we're going to have to chop through over the next couple months. It wouldn't even make sense to hazard a guess, because these are, it's sort of flying on the back of the dragon. You never quite know which way it's going to go. We're going to have to get through it whichever way it goes, whether this is a persistent, the deflationary pull that we've had for the last 25 years, technology-led deflation, or whether this is that kind of, inflationary surge, which can be okay to an extent, but can be bad if it gets out of hand. Or is it stagflation, which would be the worst possible scenario, slowing growth and high inflation? That's that 70s condition that really proved kind of very much of a challenging period for many, many assets. So just know this: when there is a clear path, we have a set of responses prepared that we will take, depending on which way the condition is depending on the momentum in which way it's headed. Because the reality is we all have to make progress regardless of what, it's sort of back to switching metaphors. We've got to fly this plane and make progress regardless of what the weather condition is. If it's clear skies, that's great. Very comfortable for everybody. If it's turbulence, it's less comfortable, but we still have to make progress, and we have a playbook that I think will be able to respond and adapt. That's really the strength of our system. So we're not really pigeonholed into one subset of assets or one particular strategy to have us make progress. We can adapt, and we will adapt going through time. So I'll leave it there. You'll hear various headlines about earnings going forward over the next really 4 weeks, and some of it, a lot of it will be noise, but some of it will be signal, and we'll be listening for the signal and trying to divine which way we think that really the strong pathway forward is going to lead us, and adapt accordingly. So having said that, if you have any questions, reach out and let us know. And as always, thank you very much. We will check in soon.